All right, good evening, everyone. This is Daniel from Tradecraft 360, providing a brief update on my cold position. So to recap, this was purchased on September 21st, 3,000 shares at $64.85, and paired with the $65 put, November 1st expiration, and that was purchased for $8.30. So the put is there for insurance, obviously. And my prior videos went over the call premium that I had generated, and I stated that I wouldn't transact till later in the week. So this is a update on those transactions. So just to dive in, yesterday I elected to sell the $65 call when natural gas sold off and cold got above 62. So 30 contracts at the 65 strike, and that generated 0.2917 cents per contract in premium. And obviously that is expired worthless today. So in the morning of today's trading action, it was somewhat clear that there was going to be continued strength in natural gas. And when the market opened, I elected to sell additional call premiums. So that's what you see here. This is the 68 call for next week. I sold for 40 cents, and I also sold the $77 call for the following week for an additional 40 cents. And then as the trading day went on and natural gas had continued momentum to the upside, I elected to sell a put with expiration today, and that's the $53 put that you see here for 15 cents. So just to recap, we have now the $65 call that has expired worthless, the $67 call that I closed out for 5 cents today just to free up some extra margin. We have the $75 call that has expired worthless, the 53 put that has expired worthless, and now going out to next week, we have the 68 strike October 4th, which is effective risk, and then we have the $75 and $80 calls with next week expiration, and I wouldn't expect those strikes to get tagged. So right now I'm going to hold off on selling any additional upside call premium just because I don't want to be overexposed. Certainly the strikes are fairly high, fairly strategic in the sense that I wouldn't anticipate there being any major problems with the $75 or $80 strike for next week. The $77 strike for the following, maybe. That depends on obviously what natural gas does. So hard to say. Obviously, just so I'm very clear with everyone, this is a losing position. However, I've already predefined my loss with the $65 put. And the premium that I have generated thus far is $2.70, and there is only $5.61 left to cover on this $65 put that you see here. So fairly good start in the sense of covering the cost of the insurance. Obviously, in terms of the trade itself, in a losing position, and the goal here would be obviously always to make money. And if that's not possible, to not lose money. There is always an opportunity cost, obviously, in terms of the capital deployed, the margin, etc. There's always a real cost to that aspect of these trades. That said, towards the end of the month, ideally then, if not to make money, cover the value of the insurance, establish a lower cost basis, and then if I elect to short again, then I'm in a much better position than I was prior. So I'll keep everyone posted on how things continue to evolve, and always look forward to hearing what people have to say. So I'll leave it there, and look forward to updating for next week. All right, everyone, have a great evening, and take care. Bye-bye.